What if I told you the biggest opportunity in gold and silver is happening right now, but most people are completely missing it? Prices go up, people get excited, prices go down, people panic. That's how the average investor behaves. But the real game? It's played very differently, because while the public reacts emotionally, the smart money moves strategically. And right now, something very unusual is happening. The same assets that have protected wealth for hundreds of years, gold and silver, are still not owned by most investors. In fact, even large institutions barely hold any meaningful percentage of these metals. Think about that. We are living in a time of massive money printing, rising global debt, and economic uncertainty. Yet gold and silver are still not crowded trades. That alone should make you pause. Because real bubbles don't happen when nobody owns something. They happen when everyone owns it. And right now, we are nowhere near that stage. In fact, some of the smartest investors are doing the exact opposite of what the crowd is doing. They are not chasing hype. They are quietly accumulating. Some even base their entire strategy on one simple idea: the gold to silver ratio. When silver becomes too cheap compared to gold, they shift heavily into silver. When gold becomes cheap, they shift back. This is not emotional investing. This is calculated positioning. And history shows those who understand these cycles often come out far ahead. Welcome to Gold Silver Scope, where we break down gold and silver in a simple, clear, and powerful way, so you can understand what's really happening behind the scenes. Because what you're about to learn could completely change how you see this market. To understand why gold and silver still have massive potential, you need to look at one simple but powerful concept: ownership. For any asset to be in a bubble, a large percentage of investors must already own it. That's when prices become disconnected from reality. But in the case of gold, the numbers tell a very different story. Institutional investors, the biggest players in the world, hold surprisingly small amounts of gold in their portfolios. Hedge funds, pension funds, and large asset managers often allocate only a tiny percentage, sometimes as low as 1 to 3%. That's extremely low. In past bubbles, allocations usually rise to much higher levels. That's when markets become overheated and eventually collapse. But here, we're not even close. This means one thing: there is still a lot of room for capital to enter the market. Now think about the world we live in today. The number of wealthy individuals has exploded compared to previous decades. There are hundreds of billionaires globally, all capable of moving massive amounts of money very quickly. If even a small portion of that capital decides to move into gold and silver, the impact on prices could be huge. And this is where things get interesting. Despite rising prices, many investors are still skeptical. They don't fully trust the move. They think it's temporary. They wait on the sidelines. But historically, this is exactly how early stages of bull markets look. Doubt is still high, ownership is still low, and smart money is quietly building positions. This disconnect between price and ownership is one of the strongest signals that the market is not finished. It may just be getting started. Now let's take a step back and look at history, because history often gives us the clearest clues about the future. During the early 1930s, the world faced one of the worst economic crises ever: the Great Depression. People lost trust in banks, paper money, and the financial system itself. What did they do? They rushed toward gold. They wanted something real, something tangible, something they could trust. Eventually, the government had to step in and completely restructure the system. Gold was revalued, not because it suddenly became more valuable, but because the system needed to reset. That moment tells us something very important. In times of crisis, gold becomes the anchor of trust. Now fast forward to today. We are once again seeing massive levels of debt, economic uncertainty, and pressure on currencies. Governments are borrowing more than ever before, and central banks continue to create more money. If gold were used to balance or back this system again, its price would not just rise slightly, it could move to levels that seem unbelievable today. And this is not about prediction, it's about understanding the relationship between money, debt, and trust. Because when trust in the system weakens, people don't run toward paper, they run toward real assets. And gold has always been at the center of that shift. But here's where things become even more interesting, because while all of this is happening, the behavior of the public is telling a completely different story. Instead of buying gold and silver, many retail investors are actually selling. Yes, even during price increases. One of the clearest signs of this is the drop in premiums on physical coins. Normally, when demand is strong, these premiums rise. But when people are selling, dealers offer less, sometimes even below market price. This shows weak retail demand. At the same time, global demand, especially from large players, continues to grow quietly in the background. This creates a powerful divergence. On one side, everyday investors are stepping away. On the other side, institutions and large buyers are stepping in. And this is exactly how major bull markets begin. The early phase is driven by smart money. The public joins much later, usually when prices are already much higher. Now combine this with another critical factor, the global economy. After 1971, when the world moved away from gold-backed money, governments gained the ability to create unlimited currency. And since then, debt has exploded. But something changed after 2008. The system became heavily dependent on money creation. Today, every dollar of new debt produces less and less economic growth. In simple terms, the system is becoming less efficient and more fragile. And in such an environment, assets like gold and silver are no longer just investments. They become protection. When you put all of this together, the picture becomes very clear. Gold and silver are not in a bubble. They are not overowned. They are not even fully understood by most investors. Instead, they are quietly moving through the early stages of a much larger cycle. We have rising global debt, weakening currencies, declining economic efficiency, and increasing uncertainty across the world. And throughout history, these conditions have always led to one outcome: a shift toward real assets. The most important thing to understand is this: the opportunity is not when everyone is talking about it. The opportunity is when most people are ignoring it, doubting it, or even selling it. That's where we are today. So, instead of focusing on short-term price moves, take a step back. Look at the bigger picture. Look at the trends that are shaping the future. Because the real story is not what people are saying. It's what the smart money is doing. If you want to stay ahead of these trends and truly understand the gold and silver market in a simple and powerful way, make sure you follow Gold Silver Cheers Scope.